finally got you on Real Vision Television, actually in person. People probably know your voice from the voice behind the Santiago Capital presentations, which people love, really fascinating.
Thank you.
And now finally come to California and met you. So give us a little introduction about what you do.
Sure.
And just so people are more familiar with.
Yep. So I started my Wall Street career, about 15 years ago, late 90s, in New York with a firm called Donaldson, Lufkin and Jenrette. Moved to California shortly thereafter and worked for Credit Suisse for about 10 years in their high net worth group, managing money for wealthy families and individuals, and mainly in Silicon Valley. Left there in 2010 and worked for an independent RIA called Baker Avenue Asset Management. In addition to that, I run Santiago Capital, which is a precious metals solution for my clients.
So, precious metals is what we're going to talk about.
Absolutely.
And particularly, I think there's so much going on in the world right now,
Absolutely.
And we're going to try and get this interview out quickly because I think it's going to be timely what's going on. Let's talk a little bit about what happened. It was yesterday, wasn't it?
It was yesterday, yeah. And it's still happening today, but it happened yesterday.
Talk to me about the Swiss franc.
Well, it's funny, as a gold guy, I wake up about 3 or 4 times a night and check my email. And I woke up about 3 in the morning, 4 in the morning, and I saw an email from somebody, and all it said was "wow." And so then I had to get up and see what this "wow" is about. And Thomas Jordan, the head of the Central Bank of Switzerland, basically canceled the peg. They'd had this peg against the euro for 3 years at 120, and he said, "Come hell or high water, we're maintaining this peg." But then they decided they weren't going to maintain the peg, and the Swiss franc appreciated, I think, 30% immediately, and it's kind of settled back down at about a 15% appreciation. But massive move in a currency. Probably one of the biggest moves in, 50 years, 60 years.
Yeah, it's one of the biggest moves I've ever seen in a major currency. And I think what's interesting, I think most of it is actually still to do not just with the Swiss franc, but it's actually to do with the dollar revaluation.
Sure.
And the pressure that's putting on everybody around the world.
You've been talking about it for 6 months. So, I'm not telling you anything you don't already know, but the strength of the dollar is going to be a cause of a lot of potential problems. Not just for Switzerland, not just for the euro, but kind of all over the world.
Yeah, I was talking to somebody earlier today about the fact that the Swiss franc peg breaking like this and revaluing higher is something that people aren't used to see currencies revalue.
Yeah.
And I kind of feel like it's a microcosm of what's going to happen to the dollar as it revalues higher versus the rest of the world. And we can see what kind of knock-on effects that's going to have.
Sure. Well, and I should say, long term, I'm a very big dollar bear. I think the U.S. has a lot of problems, and there's really only a couple of ways out of them, and none of them are good. But in the short term, the dollar is still the reserve currency, and it will still be the reserve currency until the day that it's not. And that means that when people have a flight to quality, the dollar will be one of the main places that they go.
What I thought was really interesting, I was looking back on last year, and do you know what the second best performing currency was last year in the world? The only other currency in the world?
Well, I think it was gold, right?
Yeah.
That's right. Yeah, I do know that.
Which is fascinating.
Small victories.
Yeah, but it's fascinating because, as you know, gold is not you can't just look at it in dollar terms. It's an asset you have to value relative to all other assets.
Sure, absolutely. And if you lived in Moscow and you owned gold, you're a pretty happy person that you did. It's anytime a currency goes down a lot, the real asset, something tangible, is going to increase in value. So the idea before that currency changes, like
what we're showing you here on our YouTube channel, is just the tip of the iceberg. No matter where you are in your financial journey, whether you're a beginner just looking to break into the market or a financial professional looking to up your game, Real Vision has something for everyone. Every day, our team of expert journalists provides in-depth analysis, written reports, access to live streams, and access to our community, The Exchange, where you can interact with people just like you from all over the world. For just $1, you can unlock all of this and more at realvision.com. Try our Essential tier. If you like what you see, it's only $20 a month thereafter. So click on the link in the description, go to realvision.com, and see what you think. We look forward to seeing you there.
It's anytime a currency goes down a lot, the real asset, something tangible, is going to increase in value. So the idea before that currency changes like that, you want to have something of value. But the flip side is the dollar. Even though I'm a big gold guy and I'm a big believer that you have to own gold, the dollar is still the reserve currency, and people will still fly to the dollar until the day they don't. Right.
So talking about gold as a as a hard asset.
Sure.
How come the other hard assets, or perceived hard assets, art, cars, wine, all of these things have continued, and property, high-end property, why have they gone up and gold didn't?
Well, that's the million-dollar question. Maybe it's the timing thing. Typically, the way inflation works is the people that get the money first spend the money first. The millionaires, billionaires. The way the monetary system is designed, they get the money first, and they've got to put their excess capital somewhere. And maybe they've already got some gold stashed somewhere that and they don't talk about it, but their excess money is going into buying apartments in New York City or London. They're buying Picassos for $150 million or Ferraris for $85 million. So in the very high-end luxury world, if that's the way you want to describe it, you've seen a lot of inflation. People going in and buying things. Now, I don't know if they're doing it just because they need somewhere to put their money, or because they've made the conscious decision that this is not going to end well for the currencies involved, and we're going to buy hard assets. But one way or the other, you have seen a lot of asset appreciation in stocks, real estate, art, automobiles. Gold is still trailing, and I think part of that is a confidence thing. Gold is very much a confidence asset. Like them or not, central bankers have done a good job of convincing everybody that they have everything under control.
Actually, that's a good point, because if people think things are under control and they're planning for the future, it's easier to buy classic cars.
Sure.
Because they're going up in price, you can pass them on, because it's a confidence market right now.
Right.
But you've still got a hard asset.
Not only that, but if you go out and you buy a Ferrari, you can tell your everybody, hey, come over and check out my Ferrari. You go out and you buy a couple bars of gold and you say, hey, come over and check out my gold. Number one, you don't want to tell them where your gold is. But number two, they start looking at you a little funny. The gold bugs have been reduced to the lunatic fringe. Rightly or wrongly, that's where most people, you start telling them you're in the gold world or you buy gold, first thing they do is laugh a little bit. Now, if they take the time to have a serious conversation, maybe at the end of the conversation they're not laughing, but initially it does produce a snicker for a lot of people.
I wonder if you looked at the spread between, let's say, classic cars or contemporary art versus gold.
Oh, it would be massive. It would be massive. Gold has depreciated over the last few years, whereas that market has, gone in the other direction.
And it kind of makes me think, if I look what's happening in Russia, for example, that the Russians have got to be sellers of those assets, because that's why they bought them. They bought them for this.
Absolutely.
And it worked. So they own this $200 million apartment in London.
Yep.
They can now sell it.
Yep.
And they've saved themselves quite a lot of money. But you've got to imagine that gold gets a bid potentially out of that.
Absolutely. I mean, gold is one of those things, you have to own it. In today's environment, you have to own it. I say this all the time, and I always say it half jokingly, but it's really serious. If you believe in math, you have to own gold. Maybe you only own 1%, but it's not zero.
And what math are we talking about?
Well, you look at the amount of currencies that have been printed over the last couple of years. You look at the trajectory of the debt. And then if you go through the mechanics of the monetary system and how money gets into the system and where it goes and how it's produced and how it will then grow inevitably, it's an exponential system. For the system to survive, the system has to grow. The reason that central bankers hate deflation is because the system that they've designed cannot survive under sustained deflation. You can have deflation for a year, a couple of years, as long as it's not severe. But if you have severe deflation, the whole system comes down. And so, you really need to look at the underpinnings of the market. This debt trajectory that we're on, it will continue to go higher. Even if the country had the dollars to pay off the debt, if they paid off the debt, you'd go into a depression. Because when you pay off debt, it disappears. Money is debt in the way the system is designed. You pay off the debt, the money disappears, massive deflation. So even if they want to pay it off, they can't.
When actually money is or wealth, debt is the inverse of wealth.
Absolutely.
But people got that confused somewhere.
Right. Unless you work for CNBC.
If you, let's just think through the Swiss situation and to see whether there's any impacts on gold we should be exploring. Because one of the things is the day that peg was put on was the day that gold topped out.
That's absolutely right.
Any thoughts on that?
Well, my initial thought was wow, even the Swiss are now devaluing their currency. The long-held store value Swiss franc, now it's under pressure. And all the central banks are printing. This has got to be good for gold. But it hasn't happened. It's exactly the opposite has happened. Now, I think it's an immensely interesting time. It hasn't been a fun 3 years to be in the gold world, but it's been incredibly interesting. And I'm one of these people who says there has to be some part of your portfolio, 1%, 5%, 10%. You put the probability on it. Unless you are 100% sure that the central bankers have everything under control, you have to have something that's the inverse of the central bankers. Gold is the inverse of the central bankers. I'm not quite sure why gold has gone down over the last 3 years, other than the fact it's a confidence game. And confidence in central bankers is at its peak. It's never been higher. Yet, this move by the Swiss National Bank a couple days ago, I think that's the first chink in the armor of the central banks. Draghi's got a big test next week. What's he going to do? He said it's going to be enough. We'll see. Janet Yellen has a huge challenge ahead of her. They've stopped their stimulus program, but now we're seeing forces of deflation here. Are they going to sit by now and let the patient stand on its own? Or are they going to come back with another round?
But surely gold's not just a one-trick pony that the moment the system breaks down, that's when gold does well. It's got to be an asset that has an ability to, well, it did only a few years ago, so it's only because it's been a bear market recently, but just appreciates over time in a normal course of events. It can't be a binary asset.
That's right. And there's a lot of different ways to play gold. Now, I'm a big believer in actually having the physical bullion. A lot of guys will buy ETFs or a mutual fund, and that's fine as a trade. But one of the reasons to own gold is the big trade, like the big reset or a big break of something. In that case, you need to have the physical gold, because if you think you're going to get it out of this New York Stock Exchange that's closed for a week, you're wrong. But there's lots of different ways to play gold in the meantime. You can buy options, you can do ETFs, you can buy the miners. Over long periods of time, some of the quality miners can actually produce a great deal of wealth, not just protect it.
Yeah, and I guess that's one thing people forget is people always often with gold go from here to the apocalypse. And the the big reset. But in fact, once you get back into a trending bull market, you can just trade it as a normal asset. It doesn't have to be the end of the world that gets gold to go up. What do we need to get gold to go up? Because from what we're seeing and tell me if I'm wrong, we're seeing demand in the East for gold. A lot of demand, and yet the gold price keeps falling.
That's right. So yeah, at some point that flow from west to east, the west will be empty. So that would be one thing to push gold up. I think you're already starting to see some of that. The second thing we've been talking about a little bit, I really think it's a confidence game. Again, central bankers have ultimate power right now. Their power has never been greater. The belief in them has never been greater. Now, we're starting to see a few chinks, but for the most part, the markets still believe in them. You see a few more chinks in the central bank armor, and I think you're going to start to see a flight to quality back to gold.
But playing slight devil's advocate here, I understand the confidence game issue, which is the bigger revaluation of gold, but why, if the demand is so big for physical gold, why is it falling all the time?
Well, I think because the demand for the physical gold in the West is not there. Still, even though the growth of Asia over the last several years and a couple decades, the main capital markets still exist in the West, Europe and North America. People in North America could care less about gold. You walk out on the streets of San Francisco, you ask 100 people if anybody's ever held a piece of gold in their hand, other than the ring on their finger, maybe one, maybe two. You ask them what the price of gold, they'll have no clue. So it's not part of the mentality. It's not part of the psyche, the way it is in maybe some of the other emerging countries that have gone through revolutions, who have gone through currency devaluations, who have gone through inflations before. In America, the Great Terror is the Depression. We all have a grandpa or a grandma who lived through the Great Depression and save, 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 eat everything on your plate. That's their baseline. Germany's the exact opposite. They all have somebody who lived through the hyperinflation and, don't print too much money. Whatever you do, be careful. We can't let inflation get out of control. So it's two very different viewpoints. People in India, I think China's recently surpassed them, but for decades, India was the biggest gold buyer in the world. When they buy gold, they don't even view it as spending money. They view it as saving money because they know over time gold equals wealth. I think when the Dow, the S&P, when it stops going up because of all the stimulus that's been added, and people don't think you can just throw your money in the stock market and sit back and watch it go up, then you'll start to think about other places to put gold, and maybe that'll start coming back into the psyche here a little bit. By the time 2007, 2008 got around, gold had gone up for 7 or 8 years, 9 years at that point. And a lot more people at that point did own gold. Maybe it was through GLD or an ETF or a mutual fund, but it was much more owned than it is now.
And what's happening to the gold that was held within those ETFs? Is the volumes of those, the open interest of the ETFs falling?
Absolutely. It fell a dramatic amount last year, and it's fallen even again this year, despite the first 2 weeks have been pretty good for gold. The inventory has still been falling. So I think that flow west to east is still happening.
Right, so still in the West because the markets have been going up, because things have been okay, they've been all selling out of the gold they bought over the last several years. Right. And that's still, is there any way of getting supply and demand numbers to figure out where this imbalance is? Because right now it looks like it's more sellers than buyers, but anybody in the gold market tells you that the amount of gold being bought in the East is dwarfing what's going on. Is that the difference between paper gold and physical gold?
I think a lot of it is, right? And the other thing is that supply demand for gold is a little bit different. Supply demand for gold is not like any other commodity. Every other commodity gets used up and it eventually disappears. Every ounce of gold that's ever been found in the world is still here at some point or at some place. Now maybe it's on the bottom of the Caymans in an old shipwreck, but it's still here. And I think there's probably more gold out there than many people know. And at some price it would come to market. Now what that price is, 2,000, 5,000, 10,000, I don't know. But the demand for gold, it's not the same as anything else, or the production, about 2,500 tons a year of new gold is produced, right? But if there's more demand, if there's 3,500 tons of gold demand, well, that can take all the new supply, but then it can take 10,000 or 1,000 tons of existing stock. There's various estimates, 175,000 tons of gold in the world, 185,000, but whether that number is actually right or not, I don't know if we'll ever know, but it's a different stock to flow issue than a typical commodity is.
And what happens now with the miners? With the gold price been down low for a period of time now, are we seeing supply being taken out and the miners lowering what they're doing? Or?
Sure. So like I said before, supply is typically around 2,500 tons a year. I think 500 to 600 tons of that comes from China, which they don't export, so maybe that comes down to 2,000 tons a year. At $1,200 is about the break-even price to mine gold. Some projects are obviously more efficient than others, but $1,100 is kind of about the equilibrium price. So if we see gold go much lower or even stay at these prices, mines are going to shut down. So it'll be very tough to increase supply. And if demand then picks up because of whether a lack of confidence or because inflation starts to pick up or for whatever reason, now you're going to have an increasing demand with lower supply, or at least lower new supply coming onto the market. Now, the other factor, we've had oil has had, you think gold's been in a bear market, imagine being an oil trader for the last 6 months, right? That's one of the biggest costs for the gold miners is oil. So the fact that it has come down so much, that has helped a lot. Also the fact that the dollar has increased in value has helped a lot of the North American miners because a lot of times their projects are in places like Peru or Ecuador, Argentina, Indonesia, where those currencies have depreciated. So now the fact that the dollar has appreciated versus those currencies makes their costs a little bit cheaper. So you've got a couple things going for the miners now that we've had oil come down, and you've got the price of gold, where I think it can still be profitable, but much lower, and you're going to see mines start shutting.
Have we not seen many mines start shutting yet?
Well, you're starting to see it. There's a big one, the Barrick Gold shut down. Goldcorp announced last week that they were, writing off a project. So you are definitely starting to see it. And you look at the Toronto Venture Exchange or a number of these small gold companies up in Toronto and Vancouver, and many of these are never going to find an ounce of gold. So if you think the dollar doesn't have any value, the stock certificates from these companies aren't worth much either. But there are some quality companies out there that if you find the right ones and you do your homework and you find the good management teams who've done it before and have good projects, good reserves, I think there's real money to be made. Doesn't mean it'll be smooth, but there's money.
One of the things I've looked at is how far are the gold miners down on average from the peak?
Oh wow.
80?
Yeah, 80 or 90. Yeah.
Some usually every time I've looked at a whole sector that's down 80 or 90%, it's usually a no-brainer because the risk reward is so massively skewed in the favour of them going up over time. As you said, it can be a bit painful, but you just don't size it big, I guess.
Well, and the way I kind of look at it, and one of the things we do in our fund is, we do have exposure to gold miners. It's not the whole fund, but it's a portion of it. And I really kind of look at it as a liquid venture capital fund. We try to find as many good projects as we can. They're not all going to work out. But 2 or 3 of them pay off. One of them pays off big. It more than makes up for the other ones that are, laggards. And in the meantime, when you go into a venture capital fund, there's a J curve. The first couple of years you're putting the money to work, it goes down. But hopefully you're finding good projects, and when they turn, and when the efficiencies arrive, and when the price starts to go up, then you get the ramp goes up at a higher, steeper angle than just a normal.
So where's the sweet spot in those? So let's say oil turns up.
Sure.
Let's say it starts getting through 1400, moving higher in a reasonably steady state.
Yeah.
When does suddenly it become gold miners our go?
Well, I don't think, because of oil has come down, I don't think it has to go up very much. We get back to 1300, 1400, there's some quality companies out there that are going to start really generating some earnings. Now, the gold miners as a whole have been managed terribly. There's a lot of inefficiencies. There's a lot of money that's gone to waste. In the last couple of years, a lot of the management teams have spent time slashing costs. And perhaps there's still some slashing to do, but a lot of it's been gone, right? And so think of it like the S&P 500 coming out of 2008. In 2008, everybody was throwing everything overboard, cutting as many costs as they could. And then when the revenue started coming back, they were already pretty lean. That's happened a lot in the gold miners. Now, it's not perfect, and more can be done, but the quality miners have already cut the big expenses. And I think when you get a little bit of price appreciation, and if oil stays low, you can get some nice moves.
Now, in terms of the gold miners, in which countries do you think the most attractive opportunities are on the long side for gold miners?
Well, as far as where they're based, I think most of the quality ones are based in North America, California, or Canada, and the United States. But the projects, there's some West African projects that look really nice. There's some projects in South America that look good. It's really, what we haven't had in a long time is a really big discovery. It's been a long time since there's been a really big new gold discovery. And I think if we can get one of those, that'll generate some interest. What I think you'll see more than a new gold mine having a big discovery, though, is these companies have cut all these costs. They want to grow. You're going to start seeing mergers. You're going to start seeing the majors pick off some of these juniors that maybe have a good reserve, gold reserve in the ground, but they just don't have the money to exploit it, right? Especially after what we've seen the last couple of years. So I think you're going to start to see, assuming that we can get a steadier gold price and price of the oil stays low, you could see some merger happen. Once one merger happens, then another merger happens. So I'd be much more excited about the merger phase taking place than a new mine having a big discovery.
Let's talk about Russia a little bit.
Sure.
Is Russia's a reasonable sized gold producer?
I think that they are the second or third biggest producer. Yes.
What's happening to Russian exports? They
don't export it. The central bank buys it, is the way I understand it.
So Russia doesn't export.
China doesn't
export.
Right.
India doesn't export.
Right. There's not a lot left for everybody else.
And there's a school of thought that's brewing that maybe somewhere there's a SDR or something being put together where gold is part of it.
Sure.
For a whole block of countries, including Iran, India, Russia, China. What do you think about that?
Well, going back to Russia for a second specifically, Russia, obviously they've gone through a really, really hard time with the price of oil over the last 6 months. But until 6 months ago, they were one of the only countries that had a balanced budget. Their debt is very low. It's the lowest out of all the G20 countries. If you looked at them like a stock, you'd like them much better than the U.S. or anybody else. Their gold reserves back about 35% of their currency, of the ruble. That's compared to about 7% for the United States. So, if Russia wanted to do it, and my friend John Butler, I'm not sure if you've met John, but John has written a couple papers on this.
Do some things
and I think he's spot on. And that's kind of the trump card. And there's a lot of reasons they wouldn't do it, but if push came to shove, they could do that, or they could back their bonds with gold, for an example. And not necessarily the currency, but if you buy a Russian treasury bond in 10 years when it comes due, you can redeem it for gold. They could easily do that. It's just a matter of them, writing up the contract. So I think that's pretty interesting. And then going back to the SDR.
They can actually do that with oil as well, or
Absolutely.
gold-oil combination
Absolutely.
is a
Absolutely.
fantastic opportunity
Absolutely.
for somebody like Russia, isn't it?
Absolutely. I mean, regardless of where you kind of sit politically, I'm of the opinion that it's not good politics to back the second biggest country in the world that has nuclear weapons, gold, and oil into a corner. Yeah. But going back to the SDR discussion, I'm of the belief that because the debts have gotten so big around the world, because every country is in the same situation of having to devalue their currency to help pay off these debts, is we're going to get into a situation where a new system has to be established. Now, whether that's tomorrow, 2 years, or 20 years from now, I don't know, but to me it's coming. And the SDR, the IMF's SDR has been bandied about a lot. I think there's a lot of momentum for that to be a potential solution. I don't think it could work without gold being part of it. I think somebody would balk.
I mean, it's clearly impossible to have gold, larger scale gold-backed currencies, just not enough gold for the wealth of nations right now.
Well, that's true or not. It depends on the price. At $1,200, there's not enough gold. $10,000, there's a lot of gold, right?
Yeah, but it becomes vaguely ridiculous at that point because everyone's wedding ring is then worth 50 grand, and it all becomes a quite complicated world because there'll be an awful lot of supply.
Sure.
I don't think I can even get my head around that concept, but let's say it can go up to $10,000. I have no real issue with that. But for countries to get hold of the gold to distribute around to have a gold system again, I think it's very difficult.
I don't think it's as hard as everybody thinks it is. And the reason I say that is that this is the way it used to be. One of the most productive times in world history was when we were on classic gold standard.
No, I totally get that.
Yeah.
But how do you, as the United States, get enough gold to back your currency? Where do you get it from?
Well, we already have 8,000 tons.
Yeah.
So if we value gold, if we come out tomorrow and say, we value gold at $15,000, anybody has any gold, we'll buy it from you at $15,000, our currency's backed 100% by gold.
Right.
So, a couple of years ago when we were in the depths of these budget problems, one of the
And then what happens if China does the same thing?
They could do it as well.
It's complex. I mean, it can happen. We've seen it with the Swiss franc. Okay, we've seen these things can happen.
So I think what we're talking about, Raoul, is this is part of the reason that we've seen this flow of gold from west to east. I think a lot of these countries realize that somewhere down the road, there's going to have to be a reset of some kind. And whether that's an SDR, whether it's gold, whether it's because China does it, Russia does it, or the US does it, I think people or countries are realizing that the fiat currency regime is coming to an end to some extent. And that's why they're buying the gold. Not necessarily because they want to have a gold-backed currency, but because they want to have a seat at the table when the decisions are being made. No country on earth wants to go back to a gold standard. No politician ever wants to be shackled with a gold standard. But if you have gold, you get a seat at the table because you can tell everybody else to say, I don't agree with you, I'll go my own way and I'll use my gold.
So talk me through you hearing Alan Greenspan speak recently about gold.
It's so fun. I was literally just writing my investment letter last night. I'm sending out the presentation later today. I'll send you a copy of it. Think about this. The gold bugs versus the central bankers. It's kind of like David versus Goliath. Nobody gives David any chance. And yet, at this investment conference a few months ago, Alan Greenspan, the most famous central banker of all, at the height of central bank power, says gold is the premier currency. No currency in the world, not even the dollar, can match it. And when asked where gold will be as a result in 5 years, he says higher. How much higher? Measurably higher. So you've got the most powerful central banker of all time betting on David. Why is that?
And this is the same guy who called it the barbarous relic when he was in power and said that gold had no place in modern monetary society.
That's right. After 40 years ago, or 50 years ago in 1967, writing a paper called Gold and Economic Freedom. So he had about a 30, 40-year period in there where his mind kind of went blank.
Because he happened to work for the Federal Reserve?
Well, this was before he worked for the Federal Reserve. He was a disciple of the Ayn Rand, right? Right. But then as soon as he becomes a central banker and he has the power, maybe he thinks that he's smarter than the market. I don't know. I have a friend who suspects that he got in there, realized the system couldn't be solved, so this was his method of bringing the system down, was to print as much money as possible so that bring it down from within rather than bringing it down from without. We'll see if they're right. But going back to the David versus Goliath analogy, Malcolm Gladwell is a very famous author. He wrote the book Blink, The Tipping Point. He wrote one on David versus Goliath a year or so ago. And he explained that David wasn't really the underdog. He said David never had any intention of fighting Goliath hand-to-hand combat. That's ridiculous. So despite Goliath being this big, strong guy, that was never the intention. Not only that, but Goliath may have had some physical impairments that aren't readily available. So when David picks up his sling, he's not an underdog, because modern day military experts have shown that a sling used properly could be just as powerful as a modern day handgun. So David wasn't afraid of Goliath. He just stepped up and shot him, right? And that's my point, is gold looks like a big underdog. Everybody hates it. It's a lunatic fringe. Are you kidding? You can't beat Goliath. But in a fight to the death, you don't have to have the shiniest armor. You don't have to have the biggest sword. You just can't die. If you can't die, you can't lose. Gold can't be destroyed. It's been around for thousands of years. My guess is when we're flying to Mars to our vacation homes, on Tesla rockets, gold is still going to be valued at that point too. It's kind of an eternal currency. It's not just in the last 100 years. Pharaohs used to use it. The Indians from 5,000 years used to use it. Every part of the globe used it. If you think you're smarter than 5,000 years of global wisdom, I don't know if I can talk you out of anything.
Brent, that's perfect. We'll leave it there. Thanks very much, and
Absolutely.
we'll speak to you soon.
Thank you.
Thank you for watching this interview. This is just a taste of what we do at Real Vision. To learn more about the complex world of finance, business, and the global economy, click on the membership link in the description. Give us 7 days to change your life. This will be the best dollar you ever invest.